One.
Okay. Thanks everyone for joining us today. My name is Rachel Zhang. I am a managing director with Edwards Investment Banking. Along with Shelby and Neil, we have represented many business owners in the sale of their companies. What really differentiates us from our peers is our ability and the track record to achieve premium valuation for our selling business owners. In today's presentation, we are going to discuss the current state of the market. We're also going to share some insights into how business owners could approach exit strategy in today's market. Next slide, please. Okay, so where we are today. The US M&A market has cooled off since the highs we have seen in 2021, but the deal activity remains robust in the face of many uncertainties in the market, including rising inflation, labor, and supply chain constraints. We're definitely seeing some pullback in the markets, but the deal activity remains really strong for businesses that have higher pricing power and ability to pass through the increased costs to their customers. Next slide, please. We define the lower middle market as companies with annual revenue of less than 100 million. As you can see in the charts, the middle market deal volume is holding up relatively well comparatively to the larger deals. Most often, M&A volumes and values tend to rise during the periods of economic growth and favorable markets, and decrease during times of uncertainties and market volatility. Having said that, macroeconomic issues really tend to have less immediate impact on the lower middle market. Next slide, please. Valuation remains attractive in the middle market. The prices paid for companies have come down from the elevated level we saw in 2021, but the valuation for middle market businesses remain attractive when comparing to the historical levels. Businesses with above average financial performance really continue to account for the majority of the deal activity we're seeing today. Next slide, please. Despite many economic headwinds facing the market today, there is still a significant amount of cash available for transacting deals. The corporations are sitting on a large amount of cash reserves they've been building up. And on the other hand, private equity firms, investors, currently have a lot of dry powder ready to spend. The economic impact really varies industry by industry, and we are seeing some pullback in more cyclical industries. Having said that, the financing market continues to be robust, and strong middle market and lower middle market companies will continue to have access to financing for growth and acquisitions. Next slide, please. Inflation hit a 40-year high in June. The Federal Reserve has responded with multiple interest rate hikes. So you may ask, how does inflation affect the M&A market? Right? We think that the impact is twofold. On one hand, the inflation represents a threat to companies' earnings in real dollar terms. And on the other hand, the rising interest rate really increases the cost of financing for growth and acquisitions. Next slide. That said, regardless of the impact from economic headwinds we're seeing, it is prudent for the business owners to prepare their businesses for potential downturn in the business cycle. Many of our business owners are asking us today, why should I plan when there's so much uncertainty? Our response is, while planning doesn't really eliminate uncertainty, It can help mitigate by forcing the business owners to really focus on the future, anticipate the impact of potential changes, and develop responses. So we really encourage our clients to keep their eyes wide open and proactively attack challenges head on. And that means creating a well thought out exit plan, even if you're not selling at the moment, is critical for success despite potential headwinds, because it empowers you to pull and push the levers in response to market dynamics and business performance, and to understand potential outcomes. So over the next few slides, Neil and Shelby are going to discuss how to approach an exit strategy in light of current environment. Over to you, Neil.
Great. Hi, thanks, Rachel. Pleasure to be talking to everyone today. As Rachel said, valuations, if we can go to the next slide here. Thank you, Philip. As Rachel said, valuations have remained strong in light of inflation and interest rate pressures. But there's a great deal more than macroeconomic drivers and dry powder capital that affects the value of your company, whether selling or passing it on to the next generation. For instance, importantly, a seller or business owner must ensure that the management bench is ready for the torch to be passed on. If a sale path is chosen, it's also critically important that the financial results remain stable during the time of marketing and close. It's also important not to sell after a banner year. That's unlikely to be repeated, but you want to sell when the forecasts and projections show growth on the horizon. So unfortunately, we see many times that the business owner only decides their exit strategy, timing, and plans due to some immediate necessity. Maybe a sickness, maybe it's a death, maybe it's a profound business change. Unfortunately, this does not optimize value. The way to ensure that you sell at the right time and optimize value is to start talking to your professionals, thinking about and developing a plan, and the earlier the better. A study by Whitehorse Advisors has shown that while almost all business owners believe that having an exit strategy is important, only 15% actually have a formal written plan. We can go to the next slide. Transition in business to the next generation. Many business owners have capable children. They have relatives ready to take the helm of a company. However, the children either don't have the interest sometimes, maybe they don't have the skill level, and it's more common than not that the business does not transfer to the next generation. They must walk the delicate balance of company tradition. They have to adapt to change to respond to the competitive environment. A study by the Family Firm Institute puts the figure at only 1/3 of firms are passed on to the second generation, and under 15% are actually passed on to the third generation. So most companies ultimately choose to sell because of the difficulty of this continuity of management and due to the strong values that can be received in the marketplace. So planning allows for the legacy of what you have built to be sustained and ensure that your company asset is properly protected. So if we go to the next slide, we can see what options are available. The first question, when looking at your exit plan is to ask yourself, whether a change of control is warranted or not. By change of control, we mean a 50% ownership of the controlling shares of your company. So even with a change of control, that may mean that management may stay in place, the complete management may stay in place, but the control of your shares have changed. If a no change of control is decided, a business owner can elect to take on other investors via minority stake or continuing with the status quo potentially. If a change of control is decided, then a business owner will either sell to a strategic buyer or they will sell to a financial buyer. A strategic buyer is an industry player and likely would be known by the business owner, yourself, or the seller. They may be a competitor in the space. A financial buyer would be normally a private equity firm or a family office. Both of these types of buyers come with different attributes and considerations. For instance, a strategic buyer often finds value in unique ways, and sometimes they can drive a very high value. However, a strategic buyer also is less likely to retain all management. Strategic buyers are also more likely to take 100% stake in the company. Financial buyers are often more nimble. They can sometimes move a little faster than a strategic. If they are buying a company in the industry for the first time, this is called a platform company. If a financial buyer already has an existing platform company in the portfolio and are adding to it, this is called an add-on or a bolt-on transaction. In any case, your investment banker who you're working with will work with you to determine which path and which buyer may be preferable to you. So if we go to the next slide, one of the most important things to know and to assess when looking at your exit plan is what the value of your company. What is the value of your company, and what expectations can you expect when you go to market? So understanding this value of a company is critically important to this exit plan. Also, just as important is understanding the value drivers in planning, which allows you to plan to optimize the value of your firm. So it's important to sell not after, as I mentioned earlier, not after the banner year that cannot be repeated, but kind of while the top of the hill is still on the horizon, while there's still a significant growth forecasted. It's also important to perform with financial stability during the process of marketing or closing. And understanding these value expectations and drivers will better position you for a successful transaction and optimize the price paid for your company. What's also paramount is to derive realistic expectations, which unrealistic expectations can not only cause an unsuccessful, let's say, transaction. It can impede your ability to find something of great value for your company when you do go to market. Now, if we go to the next slide, what to expect when selling a business. So just some things to consider. Selling a business is not an easy process. It's difficult. It's time consuming. It's critical that, as I've mentioned this a few times, that you maintain stability and continuity throughout the sensitive time when you are in market. Selling a business is a full-time job. It requires an immense amount of work, whether preparing your company for sale or undergoing due diligence. Sellers are always surprised at the amount of work that is required when undergoing this process. That's why it's important to hire professionals to help manage and streamline the workload. Oftentimes, buyers ask for much more than is needed or continue asking for documents long past what is necessary to close a transaction. And so professionals, investment banks, can help you discern what is actually necessary, what is market, and if it is appropriate or needed to push back on certain requests. We do this to ensure that the process is performed in an expedited manner, that maintaining value and also limiting the risk to sellers that due diligence is not overly dragged out and unnecessarily burdensome. So that's it for me. Next, I'll hand it over to Shelby Chagrin to wrap it up and provide some anecdotal stories for you.
Good afternoon. Next slide, please. So today, what I'd like to do is share with you some lessons learned over the past 20 years working with many business owners in the successful sale of their company. And the first lesson probably applies to all of you, since most of you have had potential buyers knocking at your door. So this lesson is really a lesson in being careful. So what should you do? Well, first of all, it's very easy to ignore someone who's knocking at your door who's smaller or unknown. But what happens when someone appears to be strong or a great competitor and they're interested in your company? So here's an illustrative story that happened to us a couple years ago. We met with a business owner of a business service company who was considering selling his company. We explained the importance of a sale process, but he decided to try to sell the business on his own to a larger competitor who had approached him numerous times in the past. While we clearly understood the perils of this, we wished him good luck. 1 year later, he called back to say how disappointed and frankly exhausted he was that the deal didn't go through. What happened is unfortunately fairly common. The potential buyer, based upon preliminary information, gave the business owner what seemed to be a great offer. However, as they went through due diligence, the original offer was reduced twice, the terms were changed, and eventually it became unacceptable. So a year later, we did sell the business, and we did include this original prospective buyer. In the end, this buyer offered 30% more in our process, but still did not have the highest value nor the best fit, and it was not the ultimate buyer. The lesson learned is without a sale process, the buyer really has control versus in a well-run sale process, the seller retains control. So when someone knocks at your door, simply file the information, and when you are ready to consider selling, have an investment banker handle this for you to create a competitive situation. And the next lesson is probably the most difficult to do, which is to sell your business when things are going well. Buyers pay for not only past performance, but the potential of future opportunities. What we don't want to happen is for you to sell when we call one of the big D's happen. That can be divorce, a disagreement with family or partners, a death, or downward performance. I cannot tell you all the business owners who come to us and they say, I wish I had come earlier. So the next one is, why do we follow a precise and thoughtful process when we sell a business? You will find that we often get one bid that is considerably higher than all the other bids in a competitive prices. We've seen this time and time again. We recently sold a pet business where we had numerous offers at about 20 million, but we had one offer at 28 million. This potential buyer understood that he was going to have to pay a premium price to get this business because we were running a highly competitive process, and he had some very specific reasons for being willing to pay considerably more than everybody else. And without a process, I can tell you this would never be possible. Lastly, I want you to know the deal is never done until the money is in your bank account. Unexpected things happen all the time, and we have learned over time that patience is critical. And my final remarks to you is the sale process can be incredibly enjoyable. It is a one-time and life-changing opportunity. The outcome is often glorious. We have seen so many business owners whose lives have been changed and are extremely happy to have successfully done this. So we can help you manage to get through this to a great outcome. And with that, I'd like to turn it over to questions. I'm going to look and see what questions we have. 1 minute. So the first question, maybe I'll take that one. And it was from an anonymous caller, and it said, should I sell my business to a private equity, i.e. a financial buyer, or other competition in my industry? So he's basically asking, well, would it make sense to try to sell his business to a financial buyer / private equity or to a strategic buyer? And the answer to that really depends upon what the business owner wants to do in the future. So for example, if that business owner is relatively young, continues to be energized by the business, but certainly would like to get the funds out of the business to diversify his or her estate, then perhaps the best alternative is a financial buyer who would want that prior owner to remain with the business and potentially get what we call a second bite of the apple, i.e. a small opportunity to reinvest in the new entity. So if you think your business is going to continue to do well and you want to stay with the business, probably a financial buyer is best. For those business owners who say, you know, I'm really tired, I really want to retire, you know, I'll stay on for 6 months and no longer, probably a strategic buyer is going to be best, because generally speaking, a financial buyer is going to want the business owner to stay for an extended period. The next question is, I've heard from colleagues that we are in recession. Is this true? I'm going to give that one to Rachel.
Are we in a recession? Very good question. There are heated debates in the market about us heading into a recession. The short answer is, you know, recession is unique to everybody. Right? We're definitely seeing some industries experiencing, you know, recessionary pressure. Federal Reserve will raise interest rate until the inflation is under control. And there are certainly dark spots, you know, such as the declining retail sales, ISM, new orders, but, you know, there are bright spots as well, right? Housing permits, jobs, truck shipments are growing, right? So from a broader perspective, GDP is still forecasted to have grown 3% in Q3 2022. We've also asked our business owners about their outlook for next year, for 2023, and, you know, about a third of them, you know, said that they're definitely shifting to a defense stance, but another third is really business as usual, and the remaining third of business owners we're talking to are actually looking to expand in the new year. So again, recession is unique to everybody, and if anything, we encourage our business owners to, you know, focus on the future, anticipate the impact of potential changes, and really develop a response.
Thank you, Rachel. Oh, just a minute. Thank you, Rachel.
Do we have any other questions?
I think you're on live, Rachel, so yes, we do have one more question.
See if we have. Let me see if we have.
Oh, there we go. Okay, sorry. There was a moment that I wasn't live. Sorry. We did have one more question from one of the callers. And the question is, how do I know if it's the right time to sell my business? Neil, can you address this, please?
Sure, I'd be happy to. So when is it a good time to sell my business? That is a good question, and a question that we often get. I guess the way I would answer that is that it absolutely depends on the unique characteristics of your business. That said, you know, your professional advisors can help you with that question. For us, you know, we would look at your historical financial results. We would do a deep dive in your industry and competitive pressures and analysis, along with the personal side of the equation. So there are personal things to weigh, of course. When you want to retire, when are you ready to step away? What role you want to play post transaction, as Shelby alluded to on you know, maybe strategic versus private equity, and we would help you answer all of those questions. What is not unique, though, and how I would answer that for every company is start thinking about it now. Have a plan. Work with your investment banker to determine, you know, kind of when and how and what an appropriate exit, how an appropriate exit might take place, and develop a realistic plan with them.
So there's. Thank you. We have one more question, and we have time for this question. It says, we are 100% ESOP-owned company. Would a potential buyer be best as another ESOP company, or would a stock sale of our company or an asset sale be best? Rachel, can you address this, please? Rachel? Oh, there. Can you address this?
Yes, of course. Can you hear me well?
Yes.
Yeah, great. So yes, ESOP is very unique in a situation where you are owned by your employees. And typically, we would recommend, if you are selling, we would recommend potential buyers to be the private equity firms who have the specialty in investing in ESOP businesses. The private equity firms, financial sponsors in this case, have relevant experience in investing in ESOP and see the value from the ESOP business. And what really characterizes them differently in terms of why they are the best buyers is that they have experience working with multiple owners in a situation, and also they have experience working, keeping the management team in place and working with the management team, and then also, help the management team grow their businesses. They tend to have longer holding periods. Sometimes most of them are family office themselves. That means they have much longer holding period when they invest in the ESOP companies. And finally, I think in terms of their exit plan, 7 years or 10 years down the road, typically they have the right experience to really work with the ESOP businesses in terms of tax impact on the sale of the companies, 10 years down the road. So I think the second half of the question is it going to be a stock sale or asset sale? It could be both, depending on how we're going to structure it. But typically, if we are selling it to private equity firms, typically it would be a stock sale, but they have the right legal teams ready to go and really walk us through how to structure the deal in the best way that's best for all shareholders.
Thank you.
Any other questions, Shelby?
No, I don't see any other questions, and I want to thank all of the attendees. And I also want to say, it's easy to get a hold of Rachel, Neil, or myself anytime with any questions you may have. You can see on this page is our phone number, our emails. We're always happy to talk to anybody about any questions they may have. And, to all business owners, congratulations for starting and running a business, whether you started it or running. And we certainly would enjoy talking to you on this topic further if you have an interest. And with that, we're exactly 1 minute early, so that's great for all the attendees, and thank you very much.